After opening the previous week at 73.68, Rupee was traded with a weaker undertone as investors were of the view that growing divergence between the monetary policy stance of developed economies and emerging economies in the post-COVID-19 scenario can dent appetite for riskier assets and weigh on emerging market currencies, including the rupee. In line with the market expectation, rupee registered a low of 74.3550 on Thursday. By comparing the opening and closing level of the week, the rupee registered a depreciation of 1% in the period. After the 10-year US yield breached 1.50% and December crude futures nearly touched USD 80 per barrel on Monday last week, the rupee started to move lower, breaching the initial support at 74.00 and 74.30 level thereafter. The steep rise in Brent crude prices at close to USD 80 per barrel caused fears that an increase in oil imports could widen the trade gap. The market also believed that a strong rise in US yields shall lead to outflow of funds from emerging markets, including India, to invest in safe haven US Treasuries. Going forward, we do not expect the rupee to breach the solid support at 74.50 and quite possibly a new trading range in the domestic currency is expected to be established between 73.60 to 74.50 in the next 1 month period. We also feel that the unhedged payables of the importers will hit the market to push the rupee lower to the above suggested support at 74.50. In the last 1 month period, rupee was steady and moved in a tight range between 73.50 to 73.80. The repeated attempts to breach the 73.30 resistance amidst the dollar inflows could not materialize on fears of RBI intervention at the above level. When the entire market was moderately bullish on the rupee, backed by huge dollar inflows coming into the market, only a very few of the market analysts predicted a breach of 74.00 support before the first half of the current financial year. As a result of rising global oil prices combined with the sharp rise in US bond yields and USD index, the rupee has breached the support at 74.30 and well poised to test the next support at 74.50 over a period of time. Even if the 10-year US yield breaches the 1.60% level on a sustainable basis, we do not expect the rupee to breach the 74.50 strong support, which level provides a good opportunity to exporters to sell their medium-term receivables. The domestic currency is expected to hold the stiff support at 74.50 as huge dollar inflows are expected from HDFC bond issuance, Aditya Birla Sun Life Asset Management IPO of rupees 1,800 crores and MSCI inflows of about USD 1.3 billion expected to hit the market, which could cut the depreciating mode beyond the 74.50 mark. Foreign portfolio and direct investment inflows will likely to remain robust as India's economic recovery bolsters its appeal among South Asian economies. The intervention from RBI can be expected if the rupee breaches the 74.50 support level, but their intervention may not be strong as the central bank's main focus and effort is directed to manage surplus rupee liquidity in the system. We believe RBI's intervention will be more effective to stall the rupee's fall beyond the 75.30 level to prevent any sharp down move in the rupee exchange rate from the referred level to ensure a sustained recovery thereafter. The 10-year US yield has risen by over 20 basis points in the last 1 week after the Fed chair hinted that the central bank could begin reducing its asset purchases as early as November. Amid elevated crude oil prices, the month-end dollar demand from oil marketing companies has weakened the rupee to trade well above the 74.20 mark. But the pipeline dollar inflows of close to USD 2 billion or more could lead to a recovery in the exchange rate to 74 level before the end of next week, while the 74.50 stiff support level is expected to hold. Due to sudden weakness in the rupee exchange rate influenced by the rise in US yields and USD index, the forwards edged marginally higher across the maturities. The 3-month and 6-month forward dollar premium ended the week at 3.80% and 4.10% per annum respectively. A 20 to 25 bps increase in forwards up to 6-month maturities is due to paying interest in the market to hedge the forex liabilities due in various months up to 6-month tenor. Due to higher rupee liquidity in the banking system, estimated at over rupees 9 lakh crores, it is difficult for the forward to rise much higher from the prevailing levels for various tenors. After forecasting the currency trend for the next 3 months period, importers are recommended to hedge their short-term payables up to December 2021 maturities, targeting a spot level of 73.80 or better.